What's up, you guys? It's Cody. In this video, I want to talk about two tax strategies that you have to know about if you're looking at investing in real estate. These two tax strategies can save you tens, if not hundreds of thousands of dollars over your real estate career. And this is something you're definitely going to want to implement if you're going to be a real estate investor. So number one, let's just jump right into it. We're going to talk about the 1031 exchange. If you're not aware, the 1031 exchange allows you to sell a property and roll over your profits into a new property without paying any taxes on those gains. Now, there are some caveats around this. Basically, what you have to do is you have to work with a lawyer who can help you facilitate this actual exchange, where you're going to go through, you're going to sell the property, and instead of those funds coming to you at the time of closing, they're going to go to the lawyer. The lawyer is going to hold on to them, and then we'll fund the purchase with those funds once you have a new account ready to go, once you've got a new property, I mean. So the 1031 is so powerful because it allows you to take a property, let's say you bought it for $300,000. A couple years later, you sell it for $400,000. Now you've got, roughly, I'm just going to use some round numbers here, $100,000 worth of profits, from the property going up in value. Normally, if you just cashed out of that, you'd have to pay taxes on that $100,000. Depending on your tax rate, it could be anywhere from 20 to 40%, and also how long you held on to the property, right? So if you use the 1031 exchange, you can actually sell the property, hold the funds with that lawyer, and then roll that money into a new property that could be more expensive, and then you would be able to avoid paying any taxes on that purchase. Now, the cool thing about that is you can continue to do this. You can do it as many times as you want, and you can continue to roll up and up and up until you get into these $1 million properties. So this is how a lot of the big time real estate investors got started, because when you take a property and you sell it and you cash out, you're going to pay tons of taxes on that, and that's really going to hamper the growth that you're able to get with your portfolio, right? But if you don't have to pay taxes on that, you can just kind of roll it over into the next one. You can get to a point where you can buy these $1 million properties and you never have to pay tax on it. The cool thing about this as well is that once you've got that equity built up in the property, you can get to a point where the cash flow from the properties is going to be enough to sustain you, and ultimately you would never really have to sell the property. You could kind of just put it on autopilot, get it managed, and it would continue to spit out income every single month for you. So the 1031 is definitely one of the best tax strategies out there. There are some limitations about it. You do have to, typically have more debt on the new property than you did on the old one, and you also have to identify properties in a certain amount of time. So there are some time limits around this and restrictions with what you can do with it, but it is the number one tax strategy you have to know about if you're going to be a real estate investor. All right, now with that said, let's jump into number two. I want to keep this video short because I value your time and I want to make sure that you get a ton of value out of this. The second tax strategy I want to talk about here is cost segregation. Now, if you're not familiar with what cost segregation is it basically gives you the right or the ability to take a property and look at every single item in that property that's going to need to be replaced at some point, and you can accelerate the depreciation on that particular item. So for example, let's take a microwave in a property, right? You've got a microwave there, and that microwave, let's say it's $300, and that microwave is going to decrease in value over a period of time that the IRS has set out, and they'll say, okay, I don't know exactly how many years it is, but it's not important. Let's say it's 20 years, right? They're going to say, okay, that $300 is going to lose value to the point where now in 20 years, it's going to be worth essentially $0. Well, what they'll let you do is they'll actually let you take that $300 item and depreciate it all up front in that very first year after completing the cost segregation. So you can take that and you might be able to write off, let's say $250 worth of that microwave right there in that very first year. Now you can see that when you add up every single item in the house, I mean from fans to lights to the appliances to the flooring to the shelves, anything in the property that has some value, you can see how that would really add up and allow you to depreciate the cost of those items in the very first year that you bought the property. Now this is a super powerful strategy, and in fact, I actually did 2 cost segregation studies this year for the very first time. In most cases, you're going to want to hire somebody to do this study for you. You can do it yourself, but really to get the best benefit and the most protection, from getting an audit or something like that, it's wisest to go out there and hire a firm to actually do this report for you, because the IRS is pretty strict on these things because it is such a powerful tax advantage. They've got to be strict on what they let you do and what they don't let you do. So I went out there, I got 2 cost segregation studies done on the 2 properties that I bought last last year. And this allowed me to personally write off over $30,000 worth of taxable income that I would have had to pay last year. So this is how I wiped out over $30,000 worth of taxes that I would have had to pay. Now, the cool thing about this is I'm still going to get some depreciation in future years, so that will continue to benefit me in future years. And also I can go out there and I can sell these properties and roll them up using the 1031 exchange into a new property, and then do a cost segregation on that property to again help wipe out some of that taxable income that I've obtained through my real estate sales business, or even just real estate investing, right? The cash flows or whatever way you're going to earn money on it. So the cost segregation and the 1031, they go hand in hand so beautifully, and they're both very important tax strategies that you need to use if you're investing in real estate. Now, again, with the cost segregation, they're pretty strict with what they do let you do, and unfortunately, you do have to be considered a real estate professional, which basically means you have to spend a certain amount of hours operating in the real estate industry. So this is great for real estate agents or real estate investors who spend a lot of time looking at properties, trying to acquire financing, or even purchasing them, or doing fix and flips or anything like that. So if you're in this category, this is something you definitely have to look into, because this is going to allow you to write off so many, tens of thousands of dollars worth of taxes, and you can do it every single year. Every single time you get a new property, you can go out there and do a cost segregation study. So this is just a brief overview of 2 tax strategies that you need to know about if you're using real estate as a tool to build long-term wealth. So hopefully this video was helpful for you guys. If it was, give me a thumbs up here on the video, subscribe to the channel, and with that said, I'll catch you in the next one.